Hey everybody, Economic Analyst here. In this video, I'm going to go over the Q3 results for gross output, which, as I have mentioned before in previous videos, is a broader measure of GDP. Give you sort of an overview analysis of that, and then look at some of the longer term projections in the coming years of what that means for the economy. Now, in case if you don't know, and just to recap, we measure economic growth, economists do, in terms of GDP, which stands for gross domestic product. That is the final expenditure on consumer goods and services purchased in our economy in a given measure of time. This is measured quarterly. It is adjusted on an annual basis. So when we say the economy grew by 3.2% this quarter, it really means the economy grew on an annualized rate of 3.2%. It's generally agreed upon by economists that whenever you have a contraction, aka negative economic growth for 2 consecutive quarters, that counts as an economic recession. And when you have an expansion in the economy, it is looked at as rising GDP numbers. Now, in those rising GDP numbers, economists don't care for just a rising nominal value or a rising numerical value, but what economists try to do is adjust for consumer prices. So they take the current gross domestic product nominal figure and then take into account how much it has grown over that quarter, then take into account how much consumer prices on the aggregate have grown in that quarter. And as long as the growth rate exceeds the growth of consumer prices, it's generally counted as an expansion in the economy. But if consumer prices have expanded, then that means that the quantity of goods purchased and sold has really contracted. Gross output is a broader measure. It takes into account the sales of intermediate goods, or what businesses sell to each other to produce that final good. In an income statement, it's a way of looking at the sales or revenue of an economy, whereas GDP is just concentrating on the net income. So when you take a look at the sales and subtract out the net income, you get account for operational cost and what it takes to make that final consumer product. And that's why I find it valuable. So what I have done is aggregated the gross domestic product and the gross output, as well as what I call the producer output in this chart, and adjusted for producer and consumer prices on the gross output level. And the way to do that is by doing this, I think that I get a much broader scope of economic growth, and also it tends to be a more sensitive indicator of when the economy is going into recession. For example, you can see here in this red line, which is producer output, the blue line is gross output, and the green line is real GDP. You can see the depth of the contraction in that producer output as producer industries were selling less and less goods, which then facilitated into less and less goods being sold out in the consumer part of the economy of GDP. Now, that being said, last time I made a video of this, which was a few months ago, I predicted that the Q3 numbers, based off of high rising producer prices and then the building surging consumer prices, was going to cause Q3 gross output, real gross output, to contract. And shockingly, it did not. It slightly expanded here. Okay, so the producer side is in contraction, but thanks to real GDP, the consumption side, which has been boosted by generous stimulus dollars from the Biden administration, it has basically kept the economy afloat, but just barely. Okay. In all of this, when we take a look at the year-over-year percentage changes, of course, Q3 it plummeted, and Q2 it spiked because of the stimulus bills, and now we're seeing the feedback of those stimulus bills feeding into higher prices, which is cutting short the productivity here. Now the question becomes, will this trend continue on into Q4? Are we going to see a possible contraction into Q4? Now, as I've said before, we tend to look at the economic growth through the narrow lens of GDP, and the Atlanta Fed does a fairly good job at producing a forecast of the coming quarter's GDP numbers. Shockingly, the Atlanta Fed is saying that the annual rate of GDP growth for the Q4 is going to come in at about 7.6% as it stands now, based off of aggregated economic data that it compiles and uses historical relationships, correlations, and analyses and charts. and tables to compile and create that aggregated value. So that's remarkable that we're seeing this high growth. Now, last quarter, the third quarter started off strong and then it ended up very weak. So it is very possible that in the next month and a half or so, or really just over a month of economic data coming out, that these numbers could change quite drastically and we might see a tapering off in the GDP numbers. But I think the high spending that has been going on for Christmas in a lot of ways is what's kind of driving this elevated growth right now. It also helps that on the foreign markets, thanks to the shutdowns in foreign economies, it has caused a rally in the US dollar, which has probably mitigated a lot of, or some of, the price increases that we would have been seeing on the consumer price and producer price front. So if you've been paying attention to my analysis on the consumer prices and producer prices, I've basically been projecting out, but what I'm saying is that these consumer price increases, which we've reached almost 7% year over year, and producer price increases have reached 22 to 23%, would have been worse had it not been for this dollar rally going on that is driving up investment in the U.S. economy. And this is kind of played out in the gross output with a strong jump in the manufacturing, construction, producer industries here, okay? So this is shown here in this table chart of gross output as a percentage of GDP. Now notice here that GDP's figures are smaller than gross output because your GDP is your net income. Your gross output is your total sales, all right? If you subtract GDP from the gross output, you get what I call the producer output, and that producer output is the manufacturing, construction, development of raw materials, shipping, logistics, transportation, and wholesale to finish those goods off to prepare them for the final sale in the consumer markets. And that has undergone a strong expansion in the third quarter and will likely undergo another strong expansion in the fourth quarter. And that's basically what's keeping the economy afloat. Now, why are we seeing that relatively strong expansion in the third quarter? Now, keep in mind that part of the reason is that these are nominal figures. So one of the reasons why we're seeing that higher number is because they're seeing higher producer prices. So in order for manufacturing construction industries to keep up, they're having to spend more money. This spending on a nominal basis is showing up as a higher percentage of economic activity in relation to nominal spending on the GDP. But this is kind of a false growth, because what it's really showing is that it's a higher nominal spending because we're having higher producer prices. So while we have been seeing that we're seeing the higher nominal spending in the manufacturing industry, in reality, your producer prices, when you adjust that for producer prices, we're seeing a contraction. The offset here is that we're seeing an expansion in the consumer side of the economy, aka GDP. In real GDP terms, we're seeing an offset of this contraction, this real contraction in the producer side of the economy. But unfortunately, that can only continue for so long. Now, based off of the Atlanta Fed's strong GDP numbers coming out, and also factoring in a rising gross output expenditure due to those higher producer prices, I'm forecasting here that the percentage change in the producer markets will aggregate back up to, say, 0.1% or so, okay? So it's going to be a slight increase on the real gross output level for quarter four. And, well, actually, it's about 0.0%, so it's actually going to be about flat, give or take, okay? Now, in quarter two, we did see a contraction here. And this contraction, I was thinking, was going to continue on in the third quarter. But in the third quarter, we had that slight increase. Well, now in quarter four, it looks like it's just going to be flat for that year. Actually, it's going to be just slightly negative. And then we're going to have another negative change, just slightly, on the real producer output. And then it will probably calm out and stagnate before the economy really starts falling apart here in 2022. So in late 2022, I'm forecasting that the manufacturing side, the construction, manufacturing, producer side of the economy is going to fall into a real recession here. And that's going to have problems of stagnating GDP growth. Yet shockingly, based off the GDP growth numbers that we've been seeing, it looks like that the GDP numbers are going to stay on a real term basis, still stay positive. So on a technical basis, we're going to see the economy grow measured by GDP, but it's going to contract evidenced by a dropping red line on the producer markets. Now, the question is, what's that going to do to real gross output? Well, it's going to keep real gross output kind of stagnated until the second half of 2022. Then if these trends hold up, it's going to fall apart, and we're going to see a recession on the gross output level in 2022. And as I have demonstrated here, when we start seeing a sharp contraction in real gross output, it won't be long before we see a sharp contraction in real GDP unless if the situation changes. So how am I coming to these figures? Well, I'm factoring in the historical price increases on the producer price index level as we go into 2022 and the historical price increases that we've seen on the consumer price index level as we go into 2022. Does that mean that, this is just all that there's going to be and we're not going to see anything more than this? Well, no. It means that this could calm down, especially if the Fed engages in tightening policy. But typically speaking, when the Fed engages in tightening monetary policy, that is that has usually translated into an effect on prices about a year or two later. It does not reflect a change in prices now. It's a change in future prices, which may calm some of these distortions depending on how much tighter the Fed decides to engage in relatively less expansionary monetary policy. I can't call it contractionary monetary policy because it's not like the Fed is actually going to cut off the supply of money. They're just printing less. There's still going to be an increasing money supply. It's just going to be less of an increase. So these figures can certainly change and kind of moderate as we get closer. But right now we're looking at a contraction on the aggregate economy measured by real gross output and with a stagnating growth in real GDP. So that's what I'm looking at right now, and that can definitely be a concern here unless if changes are made drastically on the fiscal and monetary level. We're looking potentially at a 2023 economic recession just based off of higher prices, unless if we see some type of calming going on in price inflation. But I have to warn you that the figures that I'm using for the CPI price level are basically about a 5.5 to 6% annualized inflation. So not necessarily overly aggressive. It's a little bit higher than what we've been seeing for the last 2 years. But again, that's being distorted from the lull in the prices that we witnessed in 2020, although I do have the average annual inflation rate at 4.2%. And certainly speaking, if we start seeing prices moderate on the consumer and definitely on the producer level, then it can change these forecasting metrics. So it's not guaranteed that it's like, okay, well, the economic analyst here is saying that there's going to be a recession in 2023. I better prepare now. But it is saying that if we continue on this trend, if we continue going down the road there's only so much that we can outpace prices in terms of economic activity. Prices are going to catch up to this, and it will force the economy in recession. When do I think that will be? Sometime in 2023, unless if things change. And of course, this is a static look at the economy. Things always change, and it can change for the better. But right now, if it doesn't change for the better, our economy is in trouble here in the U.S. And that's all that I've got for today. Guys, I hope you have a Merry Christmas, Happy Hanukkah, Happy Holidays. Go out, celebrate, and have some fun with your family. Don't worry about the economic situation that's going on. I'll keep track of that with the data. I've got a couple of more videos that I want to produce. I'll probably make them out before the new year and get that out to you early next week, if not this weekend. So guys, I hope you have a fantastic time with your family, and I'll talk to you later.